For thousands of years, humans have traded, lent, and borrowed. Long before the term investment banking existed, in ancient Mesopotamia, temples and palaces acted as the first banks. They stored grain and silver, lent to farmers, and kept meticulous records of transactions. The concept was simple but profound. Money, or wealth, could be organized, tracked, and used to grow more wealth. Merchants in ancient Greece and Rome refined these ideas. They issued promissory notes and facilitated trade across cities, regions, and even empires. Lending became more than a necessity. It became a tool of influence. Those who controlled the flow of money could control commerce, politics, and even wars. In medieval Europe, as trade networks expanded, moneylenders and goldsmiths became indispensable. They didn't just safeguard wealth. They financed merchants, armies, and governments in Italian city-states like Florence and Venice. Banking families turned their financial acumen into political power. The Medici family, for instance, didn't merely lend money. They shaped governments, sponsored wars, and financed explorers. Lending money became a way to wield influence across Europe. The 17th century marked a revolutionary shift in finance. Amsterdam became the world's financial hub. Here, the Dutch East India Company pioneered the joint stock model. For the first time, ordinary investors could own shares in a company and participate in its profits. They could trade these shares, creating liquidity and a new type of wealth. Governments, too, began borrowing systematically from these banks, setting the stage for modern public debt markets. This was the beginning of investment banking as a concept. It was no longer just about storing and lending money. It was about organizing capital on a massive scale, creating systems of trust, and connecting investors to opportunities. These early innovations in Mesopotamia, Italy, and Amsterdam planted the seeds for the financial empires of the future, laying a foundation for the global investment banking industry we know today. By the 18th century, investment banking began to take a more recognizable form. London emerged as the new global financial center. The city of London became home to merchants, brokers, and financiers who were no longer just local bankers. They were intermediaries for governments, armies, and global trade. Financing wars, colonial expansion, and industrial growth became the core of their work. Banks like Barings and Rothschilds rose to prominence by combining secrecy, trust, and international reach. Nathan Mayer Rothschild, in particular, became legendary for his ability to move information and money faster than any rival during the Napoleonic Wars. His network of couriers and agents across Europe allowed him to act on financial intelligence faster than governments themselves. By lending to nations, arranging bonds, and financing armies, investment bankers wielded influence that could rival kings. Meanwhile, the Industrial Revolution transformed the economic landscape. Factories, railroads, and infrastructure projects required enormous sums of capital, far more than individual merchants or local banks could provide. Investment banks stepped in, connecting wealthy individuals, family offices, and institutions to these large-scale ventures. Stocks, bonds, and complex financial instruments became tools to channel capital efficiently. In the United States, early investment banking was influenced heavily by European models, but evolved rapidly in response to domestic growth. Families like the Morgans and the Drexels established banking houses that not only financed railroads, steel, and utilities, but also actively reorganized industries, stabilizing markets, and consolidating companies. They didn't just provide capital, they reshaped the American economy. By the late 19th century, investment banking was no longer a behind-the-scenes service. It was an engine of economic power, influencing government policies, industrial growth, and global trade. The industry had become both a backbone and a force multiplier for economic expansion, creating wealth on an unprecedented scale while also holding the potential for systemic risk. This period solidified the blueprint of modern investment banking, intermediating between capital and opportunity, leveraging networks of trust and information, and managing risk on a national and international scale. The foundations laid in London, Paris, Amsterdam, and New York set the stage for the towering financial institutions of the 20th century. By the early 20th century, investment banking had firmly established itself as the backbone of global finance. Wall Street emerged as the epicenter of American capitalism. Banks like J.P. Morgan & Co., Kuhn, Loeb & Co., and Goldman Sachs were no longer just intermediaries, they were power brokers, shaping industries, influencing governments, and orchestrating massive mergers and acquisitions. The era of the robber barons, with titans like J.P. Morgan, John D. Rockefeller, and Andrew Carnegie, demonstrated the scale and reach of investment banking. These bankers didn't merely fund businesses. They organized industries, railroads were consolidated, steel companies merged, and utilities were structured to attract investors. Investment bankers transformed chaotic, competitive markets into stable, profitable networks. Their influence reached from corporate boardrooms to the halls of Congress. During the Great Depression, the weaknesses of the unregulated financial system became painfully clear. Bank failures, stock market crashes, and widespread economic devastation exposed the risks inherent in concentrated financial power. In response, regulations like the Glass-Steagall Act in the United States reshaped investment banking. Commercial banking was separated from investment banking, creating safeguards but also new challenges for capital markets. The mid-20th century brought globalization. Investment banks expanded beyond national borders, financing multinational corporations. Post-war reconstruction and international trade, firms in London, New York, and Tokyo competed to manage sovereign debt, industrial expansion, and foreign investments. New financial instruments, bonds, derivatives, and securitized assets allowed banks to channel capital more efficiently while also increasing systemic complexity. By the 1980s and 1990s, deregulation and financial innovation transformed investment banking again. The repeal of Glass-Steagall, the rise of hedge funds, and the advent of complex derivatives allowed banks to become enormous engines of capital deployment and risk accumulation. Investment banks now had global reach, handling trillions in assets, facilitating cross-border mergers, and underwriting public offerings for companies in every sector of the economy. Modern investment banking is both a driver and a mirror of globalization. Mega deals, sovereign bonds, and complex derivatives demonstrate its influence on everyday life. From pension funds to household investments, the lessons of history remain clear. Investment banking can build economies, create wealth, and finance innovation, but unchecked, it can also amplify instability, concentrate power, and generate crises felt worldwide. Today, institutions like Goldman Sachs, Morgan Stanley, and Morgan Chase carry the legacy of centuries of financial innovation. Their influence extends across continents and industries, but the principles that guided investment banking from Venice to Wall Street, trust, networks, capital allocation, and risk management remain at the core. Understanding this history is not just a lesson in economics, but a roadmap to understanding power, influence, and the forces shaping our global financial system.